Hi, we saw a historic announcement on Friday, and this has re-rated our markets by close to 6 to 7%. As we speak, market is still up. I thought let me spend some time trying to go over some of the announcements that were made and what are the near-term impacts, medium-term impact, and the longer-term impact. We'll also discuss what should be your decision across your portfolio, especially when it comes to asset allocation. Should you be changing the asset allocation that you currently have? Should you be investing more in equities? We'll talk all about that. First, let me summarize the announcement made by the finance minister. They have basically cut corporate tax rates from 30 to 22% for all companies. So earlier, companies which had a turnover of less than 400 crores were taxed at 25%, and companies above that were taxed at 30%. They have reduced the tax rate across the board for all corporates in India. This is a fairly monumental announcement. In line with this, they have also brought down MAT to 15%. One of the big announcements that they made was for any company which is starting operations from 1st of October in the manufacturing sector, they will only have to pay 15% tax. So the effective tax rates come down by anywhere between 20 to 25%. This is a big move as it rationalizes the tax structure in India and aligns it with tax structures elsewhere in the globe, which also means that it will be more profitable for international companies to come and set up their operations in India and look at India as a major export hub. Last time such kind of sweeping tax changes were done in 1997. We view this as a series of announcements that the finance minister has been making over the last 6 weeks, and this is like a culmination of all the announcements they made. First, let's try and understand what will be the impact and what it aims to achieve. As you all know, the sentiment had soured quite a bit from the elections that we saw in June, the election results that we saw announced in June this year. The budget again dampened spirits. The last GDP growth print came in at 5%. So growth has been a big concern. RBI has been bearing the load of reviving growth by cutting rates aggressively. However, we didn't see enough fiscal measures. This is a big fiscal measure as the government is letting go of about 1.45 lakhs of taxes that they collect. First, to explain to you the fiscal impact, about 60% of this tax that they are foregoing will be foregone by the center, and about 40% will be foregone by the state. So the immediate question will be, is it inflationary? To an extent, state as well as center will have to cut some expenditure to ensure that they continue to meet the fiscal deficit targets. There is some room within the current provisions to save money. So I don't think the entire expenditure cut will be 1.45 lakh crores. It will be much lower. Like I said, 40% will be borne by the state, 60% will be borne by the center. At the same time, there are many set-offs as well, like divestment. As the markets have re-rated over the last couple of trading sessions, even PSU companies have become far more valuable than they were on Thursday. So if the government were to divest from some of these PSUs, they will get a larger share in the disinvestment proceeds. So there are multiple set-offs, and they are also hoping that this will lead to better demand creation, which will eventually lead to better taxes. The more important thing is that the government has put more money in the hands of the corporates, and this, we believe, part of it will lead to more deleveraging, but some of it will lead to investment demand as well. So they have again thought longer term. Instead of giving a direct consumption stimulus, they've chosen to do something that is more stimulative in the medium to longer term. Now let's come to the equity markets. Of course, a lot of companies will be immediate beneficiaries. Now, when we analyzed Nifty companies, we figured out that the average tax rate that these companies pay is closer to 29.8%. Now, different companies pay different rates of taxation. The biggest beneficiaries will be private financials, commodity companies like metals, cement, and consumer companies, because these are some of the companies which pay the highest rates of taxation, and they will be the biggest absolute beneficiaries of this tax reduction. So, like to like, nothing changing, a lot of companies will have to re-rate 10 to 15% to be at the same valuations. Of course, different companies have different tax rates, and probably a stronger move is warranted in some companies as opposed to others, and market, whilst is trying to figure out, has re-rated the entire market. Some stocks have gone up more, some stocks have gone up less. So, it is a big boost to the corporate sector. Banks obviously will be very big beneficiaries, because the profitable banks will get to retain more of their profits, and hence they will have to raise less equity from markets. Over time, we hope that this will lead to lower rates for the borrowers and better ROEs for some of the private financials. Now, let's come to the second part of equity, as to how much can markets re-rate, and does this decisively change sentiment and view on equity markets. We believe it does. Such a big move is definitely a game changer for economy and markets from a sentiment point of view. We have seen many positive voices speaking in the media over the last couple of days. Companies will also now be far more positive, because in between there was a mood developing that the government is leaning more towards the left, and they are more interested in dole outs rather than looking after the corporate sector's health. I think this puts to rest a lot of those apprehensions. So, we believe mood changes decisively. Although markets have rated 10 to 15%, we believe this has a far longer term impact than the shorter term move that we see. Hence, our view for equities has changed decisively, and we believe that people who are waiting to allocate money to equity markets or mutual funds, through mutual funds, PMS or any other products, should do so right away. To give you a sense of earnings, we believe that after this change, you will see earnings grow by 25% for this financial year and 20% for the next financial year. At the Nifty level, we had projected an EPS of 560. Now, this change alone takes the Nifty EPS to 603. So, you are seeing an 8%, close to an 8% upgrade in Nifty earnings itself. Of course, different companies will have different set of upgrades. So, we believe it doesn't make sense to wait any longer. One should complete their equity allocations immediately. Longer term impact, essentially, Warren Buffett had written a very nice note when first time USA had brought down corporate rates dramatically. Essentially, the sum and substance of what he had written was that the good quality companies will be able to retain a large part of this profit pool, especially the incremental profit pool that they get because of the tax reduction. Now, what does this mean? Essentially, if I have a very good quality business, I have products that are in demand and that are aspirational for customers, I will be able to hold my pricing and will not need to pass a lot of this lower profit to consumers. Whereas in extremely competitive industries, or rather businesses which don't have moats, over time will have to pass a large part of this incremental profits to customers, as their competitors will try to do the same. So, good quality companies stand to be biggest beneficiaries of this move, and a lot of our partners construct high quality portfolios, and you can reach out to your relationship managers to know which are the portfolios which are more positively impacted. Now, moving on to fixed income, what is the impact on fixed income? The 10-year bond yield immediately shot up to close to 680 levels, as the near term concerns are that government will widen the fiscal deficit number, and as a result it will lead to crowding out effect, which means that government will need to borrow more, and hence bond yields have shot up. Now, near term, whilst this could probably be true because we are seeing lower tax collections, and this will lead to further lowering of tax collections from corporates, and the fiscal could be a little stretched. In the medium term, we believe that this move is not inflationary in nature, because it doesn't directly put money in the hands of consumers, it puts money in the hands of corporates, and part of that money will be used for deleveraging, part of that money will be used to create more supply, leading to investment demand in the medium term. And like I said earlier, the states as well as center will pro rata have to cut expenditure to meet their fiscal deficit targets. So we believe in the near term this move is not inflationary, and as a result, once the bond markets understand the numbers better, we believe yields could come off, and RBI still has room to cut rates. So our view is that repo is at 540, RBI could cut it down to 5%. So yields will settle down, and in the medium term we see a case for lower rates. However, in the near term, rates could be more range bound. We are trying to see the impact on AAA bonds. If this leads to higher AAA bonds and hence better yields for your corporate and PSU debt funds, then actually it makes a very strong case for you to invest in these kind of funds, because these will be beneficiaries as and when rates come down in the future. As far as credit funds are concerned, we are very interested because credit spreads are extremely attractive. However, we are still evaluating the space very closely, and we'll come to you with an update. In the debt portfolios, it definitely makes sense to keep some liquidity, whether it's in arbitrage funds or ultra short term funds, because we do believe at some point you will get an opportunity in the credit space. So that is our view across equity and fixed income. Hope this was useful. Thank you very much.